Welcome to the August 31st, 2020 edition of the Nichols Tax Update Podcast. I'm Nichols, and this is my podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I hereby acknowledge the value of my subscription to Tax Notes Today, the preeminent source of information for tax professionals in preparation of this program. What's in here? What's in this edition? First, more guidance on the PPP Loan Forgiveness Program, SBA Bulletin 2020-0044. Next, we'll talk about how liens attached to an annuity payment surviving bankruptcy action. Then an IRS memo on designated taxpayer disputes for litigation. What does that mean and who cares? The Fifth Circuit has affirmed a tax court's denial of a claim for litigation costs by a taxpayer that I think is probably just better classified as a nutcase. A decision allowing a geophysical company to claim the benefit of Section 199 deduction, that's back on its 2008 return. That same geophysical company and those same expenses today would be eligible for a Section 199 Cap A treatment. We'll talk about that. The IRS has issued a practice unit explaining the foreign earned income, Section 911 income. This is the second week in a row we've talked about IRS releasing very helpful practice units, education tools. The Fifth Circuit has held a portion of Texas bankruptcy law invalid, a portion of the bankruptcy law that applied the same rule to all citizens seeking bankruptcy protection, regardless of their otherwise financial situation, otherwise than bankruptcy. And then we have a fact sheet 2020-13 on opportunity zones, a very helpful, comprehensive guide. If you want to have a fundamental education on opportunity zones, read this fact sheet. So here we go. PPP Loan Forgiveness. Who is an owner-employee? What is an owner-employee for purposes of loan forgiveness under the PPP program? The SBA now defines that, finally, as an individual with ownership of 5% or more in a corporation, either C or S, doesn't matter. That person is an owner-employee and subject to a cap on the amount of compensation that could be paid with PPP loan proceeds and then forgiven. Owners of less than 5% are not subject to that same rule. This same guidance, by the way, limits the amount of rent payments to related parties eligible for forgiveness. The maximum amount of rent payment to a related party cannot exceed the interest that is owed on any indebtedness secured by the property during the covered period. The purpose of the PPP program is to reimburse for expenses, not to pay off any debts. Remember that. Liens are still valid even after being washed through bankruptcy. Ivan Phillips, a school teacher down in Texas, had a couple of annuities with TIAA CREF. For whatever reason, he got himself in financial trouble to the end that he owed over $260,000, including penalties and interest, when he filed for bankruptcy. Some of that that's the amount that was not dischargeable. Some of the liabilities were so old and the IRS was so slow to react, they missed the statute of limitations, and so Ivan beat him on some of his income tax obligations, but he still owed him $260,000 when he filed for bankruptcy. And the IRS had filed tax liens against all of his property, which included a right to this stream of annuity payments. The question is, can Ivan knock the IRS's liens off his annuities so he gets the full amount? The answer is no. The liens pass through the bankruptcy, notwithstanding the discharge of the debtor's personal liability. So the liens continue to attach to the annuity payments even though Ivan is not personally liable for them. The IRS is going to take their money from the annuity payments as they become due and payable to Ivan. It's over $260,000, including penalties and interest, and I'm betting it's going to be a while before Ivan collects anything on his various annuities. Next, a technical issue, designated taxpayer disputes for litigation. The IRS reluctantly will designate taxpayer disputes for litigation when it is to their advantage and when they believe it's to taxpayers as a group advantage to do away with a lot of small cases where taxpayers and the IRS don't disagree, or where there's a misunderstanding of the law, or where the IRS simply wants to clarify the law. Or if you've got an abusive tax transaction which is raging across the land like wildfire, if all of a sudden everyone believed that whatever they paid for a wristwatch was tax deductible because it helped them be on time for their business appointments, or some ridiculous theory like that, the IRS would, and of course that's a small dollar amount, but the IRS would seek to have that dispute designated for litigation, which means you cannot settle it at appeals. When the IRS designates an issue for litigation, it means you're no longer able to settle that within the IRS administrative process. So the IRS gives examples by type and kind of situations where sound tax administration will be best served by establishing judicial precedent. First, to stem the proliferation of abusive tax transactions or other significant non-compliance through early resolution, or reduce future compliance and litigation costs of other taxpayers and the government in a common misunderstanding, or to resolve issues with respect to which published guidance has not resulted in compliance, or where there is wide divergence between the IRS's view and taxpayers' viewpoints on the law. Next, Paul Edwin Johnson. I believe certifiable, a nutcase, dealing with the Internal Revenue Service from positions of his own understanding. The Fifth Circuit affirmed a tax court's decision denying the couple's attorney fees and litigation costs under Section 7430 after a tax deficiency case was resolved in their favor. Well, how does that happen? If the taxpayer wins, why don't they get reimbursed their litigation costs? Well, for openers, the taxpayer won because they finally submitted the necessary evidence when they went to appeals. They somehow refused to give the IRS the evidence of the transaction, which would have straightened things out 24 pieces of correspondence before they finally got to tax court, and would have saved them the trouble of filing a petition in tax court. The court did not abuse its discretion in finding that the IRS's position was substantially justified. The taxpayers failed to provide evidence regarding an IRA rollover until they had filed a petition in tax court. Then their claim was for thousands of dollars for the taxpayers' time, but only $71 out-of-pocket costs for mailing their petition to the tax court. Would you believe that we have federal employees who are paid good money to look after these things and to contest with taxpayers about this sort of nonsense? Hopefully that'll never touch us, right? Next, processing seismic data is engineering service. I can't pronounce all that. TGS, NOPEC, Geophysical Company. The gross receipts of a corporation that was engaged in the business of acquiring, processing, and licensing marine seismic data, which was then used to identify drilling sites, some off the coast of the United States, some on our continental shelf. That constitutes domestic production gross receipts, DPGR, under the old Section 199. Those receipts are derived from engineering services, which are designated as qualifying for 199 Cap A as well. This decision involves Section 199 in a 2008 return. The same result, in my opinion, should be reached in 2020 with regard to Section 199 Cap A, because the definitions of qualifying activity are exactly the same. Next, an IRS practice unit explains Section 911 income. That's the foreign earned income exclusion. There's your citation, INT-C-219. The date, you want to look it up, by the way, by the August 27th, 2020 date on the IRS website. The classifications in that practice unit are the foreign earned income for purposes of Section 911. It's a perfect training tool for CPE, for CPAs, and enrolled agents. If I were still the tax director in a firm, I would take this practice unit, which is in the public domain, and I would use those slides in a training program for my tax staff to teach them about Code Section 911 and the foreign earned income exclusion. There's a detailed explanation of the concept, detailed what is foreign earned income and what is not. That, by the way, takes 3 slides, all pretty full of copy. Then there's an index of reference sources, the code, the regulations, rulings, notices, and revenue procedures. All the information you would need to look up to understand some of the fine points of Code Section 911 and the IRS's own explanation of what is foreign earned income and what is not. A portion of the Texas bankruptcy statute is invalid. This is the matter of Annette Marie Diaz versus Mary K. Vigeland. Vigeland is the bankruptcy trustee. This is in the Fifth Circuit, going up to the bankruptcy panel for the Fifth Circuit. The bankruptcy panel determines that in 2010, there was a U.S. Supreme Court decision which allowed low-income debtors to keep more money in a Chapter 13 bankruptcy. Now, a Chapter 13 bankruptcy is a wage earner bankruptcy, where we agree to pay a portion of our income over a period of years to our creditors and be paid. Mary Vigen, as the bankruptcy trustee, would collect the money, and then she would disperse that to Annette Marie Diaz's creditors in accordance with the plan. So the plan Ms. Diaz presents has her keeping $3,261, which is the full amount of a tax refund. Initially, the bankruptcy court said, oh no, you can only keep $2,000 because that's what the Texas bankruptcy statute allows you to keep. But Ms. Diaz had a smart lawyer who paid attention to current developments, and he knew that in 2010, the U.S. Supreme Court said that a low-income taxpayer could keep more money. They could file a 2013 plan which allowed them to keep more money than a Chapter 13 plan than a Chapter 13 plan by a high-income taxpayer would allow them to keep. The idea being it's a matter of resources and resources that you need. The low-income taxpayer had a greater need for the tax refund than the high-income taxpayer. I don't know whether that's a social issue or not, but in any event, Ms. Diaz has a successful Chapter 13 plan, even though she retains $3,261, the entire amount of her tax refund, not limited by the $2,000 that the Texas bankruptcy statute would have limited her to before this decision, which will be good law in the Fifth Circuit for sure. Finally, this week, an explanation of opportunity zones in a fact sheet. One of the better things the IRS did last week was Fact Sheet 2020-13. We're coming into the tax planning season when our high-income, high-net-worth clients are going to be looking around for tax shelters. If they have long-term capital gains, they may want to consider reinvesting those gains in a qualified opportunity zone fund. Following a nomination process, thousands of communities around the country, including hundreds in South Carolina, were certified as qualified opportunity zones. Qualified opportunity zones provide tax benefits to business or individual investors who can elect to temporarily defer tax on capital gains if they timely invest eligible gains in a qualified opportunity fund. You have to leave the money in the fund for a specified period of time in order to get the full benefit. A qualified opportunity fund is organized to invest in qualified opportunity zone property or qualified opportunity zone businesses, which are described in the fact sheet. In slide 2 of 2 here, the fact sheet describes the benefits of investing in qualified opportunity funds, the deferral of eligible gain, what a qualified opportunity fund is, what qualified opportunity zone property is, and what a qualified opportunity zone business is. Those are succinct explanations. Each one of those explanations that are detailed in that 5-point drop-down menu take about a quarter of a page. This is not a hard read, and when you're done with it, you'll be fully informed and up to date on what you need to explain the rough parts, just a rough cut of what a qualified opportunity zone investment might be for a client that qualifies. The fact sheet includes, by the way, a list of resources, final regulations, published guidance, and forms. Well, folks, believe it or not, that's a wrap for this week. Until next week, not on the slide, but please stay safe.